Now we're going to turn to refined products, and we want to look a bit deeper in terms of where do we sit now, where have we been normally, and we always turn to the looking at it on the 4-week rolling average as well as where we are currently in 2021. So here you can see that we essentially flatlined, and this is what we were talking about, where we were going to get some increases in one, decreases in another. Gasoline remained elevated versus what we were expecting, with a little bit of a move lower in distillate, an increase in jet, and we got a little bit of a flip in some of that. But we'll go through it piece by piece. Here you can see on the 4-week rolling average, we're at about 14.8 million barrels a day of demand. And you can see that typically this is that pivot point, and it changes depending on really where is Memorial Day versus each year, where you typically have this pivot higher as we go into July 4th. Typically we see this acceleration point. And instead, we just didn't get an acceleration point. We just went flat. And that's what we've been talking about, where we could get some increases in one, decreases in another, and we're just not seeing a big move altogether higher. The 4-week rolling average is drifting up. Now it's back to kind of those highs that we had at the beginning of May, or I should say mid-May, when we're looking at Memorial Day. And not just Memorial Day, but also the Colonial Pipeline backdrop that just sent that higher. And that's where we're getting back to kind of where those delays were. And it's, again, how much of it is really strength versus just timing. And that's where, when we look at where we sit, we should be pivoting up. And instead, we're going sideways. And that's what we continue to see, is kind of this running mantra of just sideways, where we'll get fluctuations up and down, some good weeks, some weak weeks. And that's why we talk about the importance of that 4-week average, which is where when we look at the 2017, 2018, 2019, 2020, those are averages. So those averages, typically you see all of them pulling higher, and we're just not getting that same type of support from the underlying components. And when we turn to distillate, here you can see that typically we turn higher. We normally get this pivot point up. The rate of change accelerated right out of the gate, but now we're starting to pace kind of what that 5-year average is. We had a build of 1.75 million. It was driven by pad 2, 3, and 5. We're still 6.5 million below that 5-year average, but just if you think about where 2020 is, we're really kind of right in line with that 5-year average, but we're still trending up, and there's still room. Like, just look at the gap between, the peak of that cloud and where we currently sit. There's more than enough room in distillate, especially given how we're now recovering jet and kerosene. So there's really no need to continue to dump into this, and there hasn't been for a while. But just to give you an idea that this is now going to be a place that these refiners can increase their heavy runs. There's room in the distillate tanks, and they can try to focus on where gasoline is, where some of these floating movements are. While imports still remain elevated, we took one cargo from Russia. That was just an opportunistic move. So you can see that we're still 187,000 barrels a day over normal. Even though we dipped 96,000 barrels. Again, this is just going to be that timing where imports will continue to drift lower. They'll still remain elevated just because we do have additional cargoes coming in from Asia. If it makes sense to come to the U.S., especially Pad 1, that's where we still have the steepest disconnect between historics, which means that there might be some opportunity. So we could see some of that come into Pad 1. Our exports will remain under pressure, just given where Europe sits and what they're taking in from Asia. But again, these are things that we're looking at. But all of this is just going to show that we're going to get builds, which we normally get. The question is going to be the rate of change. And we believe the rate of change is going to be elevated, not because we're running a ton of distillate. It's more because we're just going to have a big acceleration from the lack of exports, which is going to leave more in the tanks, which is going to push Pad 3 higher. We're 3.4 million barrels above the 5-year average in Pad 3, and we think that's going to be an acceleration point, which is going to make this rate of change higher than it really should be. And then when we look at demand, as we were saying, we expected it to fall back down, fell back into this kind of normal range, and it's still elevated. So it's not that we're not saying that we're going to see a drop down. We're just going to follow kind of this seasonal norm. So we will get a recovery in demand, and then we'll get a drop back down. And again, we're just going to work within this normal kind of range for the most part. It's a little noisy, but just given the year so far, you can see that we've tracked above the 5-year average. That's still going to be the case. We still have a lot of trucking demand. We still have a lot of rail demand. We still have a ton of cargoes coming into the U.S. from the shipping side, which again is going to keep this elevated in general. And here you can see kind of that recovery in shipping. Now we're starting to see a little bit of a normalizing level, and it's just because rates continue to go up, and rates are under pressure, are pressuring to the upside. We talked about the labor shortages causing some gasoline shortages in Denver and Iowa. Again, these are one-offs, but it's just highlighting just how troubled the supply chain really is. So even, we're starting to get a little bit of a normalization, but these rates is, again, well, do I need it right now? Or instead of getting one cargo, I can get 10 cargoes from a rail car, a rail car. And that's what we're starting to see, where rail is continuing to be very robust. We're seeing a lot of that intermodal continue to move throughout the system, and it's not going to take trucking down. It's just going to cap some of these moves as diesel remains elevated. Now, where the 2020 comps are starting to get a little bit more normal, if you will. If you think about where 2020 this summer was, we did get some recovery, which again is making these comps a little bit more normal. But when we look at some of the backdrops, in general, coal is going to continue to move just because it's coal and just where some of the pricing is. But the biggest shift that we're going to continue to see, grains will remain elevated, as well as farm products, forest products. Forest products is the big one, where because there's such a shortfall for drivers, we're seeing a decent amount of lumber cars get purchased, get rented, I should say leased, so there's going to be a continuation on that side as intermodal remains elevated. It's in the middle to upper double digits. That isn't going to change anytime soon, just given some of these shortfalls in general. So then when we look at just what is happening on the on the shipping side, as we keep saying, just when you think you're getting ahead of it, we keep seeing this new surge of containers. We can't get ahead of it. We won't get ahead of it this year. We're so short on inventories. We're so short on just where the demand is strong. Inventories are short. The supply lines remain stretched, which is why a lot of this is just. Some of this is even delays. So these, companies were expecting this to be there, 10, 15 weeks ago. So that's why there's going to continue to be this movement. And they're going to want to, even after they start to catch up with demand, they're going to want to see some of their inventory recuperated. So again, this is where we're going to continue to see some of these demand levels on not just the shipping side, but also on the rail and trucking side. And just to put it into context, how big this surge really is, here's where you can see on where we normally are. If you go back to this peak of 2006, and just how we continue to be at this peak level, and now we've just blown through this peak, and there's really nothing to stop this level. This may be the peak. We may roll over, but again, we're going to have a lot of support to stay at these highs. So then when we shift into what the market looks like for heating, here you can see that, or I should say cooling, there's still that heat wave that is hitting the really pad 5, pad 4, where things have cooled down a bit in the south and as you go into the southwest. But this big heat wave is really going to continue to pull out natural gas. We've seen electricity spikes. They've actually requested people in California to delay or change the way they charge their EVs. Something that was funny was the UK saw their natural gas prices spike higher because the wind isn't blowing. And again, these are some of the things that we have to consider when we're considering renewables, because this is going to require more natural gas, more propane, where are some of these levels? And if you don't have a renewable, or if your renewable is backstopped by natural gas and natural gas isn't there, well, then it becomes diesel. So these are things to consider as these climate shifts continue. Now, when we go into, let me just pull up the yield so we can talk yield as well. So here's where we get into the gasoline side. Gasoline had a draw of 2.9 million barrels, bringing us really right in line with the 5-year average of 1.4 million, just below by 1.4 million. But remember that 2020 was a massive level. And the whole draw was driven by Pad 3. So Pad 3 had a draw of 4.28 million barrels. Everywhere else had pretty much a build. So when you look at the 5-year average, Pad 3 is 1.7 million barrels above the 5-year average. But when you look at what happens normally, and you can take the bottom of the cloud, top of the cloud, that 29-year average, we normally start to roll over and we start to see an acceleration to the downside. So we had these counter-seasonal builds, and now we're starting from a very elevated level, and we need to see this accelerate down to really bring us back into some sort of normalcy. And as we've been saying, the longer we just stay sideways is going to become a detriment because the levels get more and more difficult, because we normally see draws. We haven't seen all that many draws in general. You can see that we've had that steady move up. So now we're starting to see some of that movement, but we're not seeing it accelerate. And it's really driven based on how the refiners are doing. They're targeting, so their production's at 62.7%, targeted at gasoline. That's down from that peak of about 64%. So we're going to start to see that walk back up, especially because the production on distillate is starting to increase. That was up to 31.7%, because you're going to have to see that increase in order to also see gasoline increase, while imports were 49,000 barrels a day above the 5-year average. And it was sitting at, so it dropped week over week by 210,000, which is what we were really saying was we're going to come to this kind of comfort level. And that's where, 840,000 barrels a day was what we imported. We're going to sit around that number, whether it be 840 to 900 to 760, and then but we're going to stay within this level, because this is a very good market for gasoline. It's going to keep our exports fairly low. We do have some caveats on what our exports were. We'll get to that in segment 3. But the production is going to remain elevated, and the question is going to be, will we see some of the demand that has been expected really come back in size to help draw down? But can it draw down faster? Because when you look at just the pace, we typically see draws at this point in time that really go down into the first week of September. Because if you look from peak to trough, when you went from let's say the middle of June to the beginning of September, we typically have a fairly excessive drawdown, and we just haven't really seen that so far. Now, when we look at where we sit today, we had a nice little week in gasoline, where according to GasBuddy, last week's U.S. gasoline demand rose 2.87% from the prior week to a new COVID high. And then when you look at Sunday, so now Sunday was down 0.7% versus the prior Sunday, but up 5.3% on the last 4 Sundays. Monday was down, and now Tuesday was down. So here's kind of get that peak, and now we're going to start to see some of this level off. But again, it's not like we're coming back down to where we were in this batch over on the left. It's just going to be again closer to where we were the previous week or the week prior, where we're going to work within now this kind of sideways move as we go through the remainder of the summer, or I should say at least until we get into July, because now GasBuddy has their prediction on where gas prices will be. $3.11. It's getting close to where we were back in 2011, 2012, 2013, 2014. This is kind of where we're sitting right now at $3.11, and you can see how expensive it is versus 15 through 20. Now, this is going to be You could say, well, we've been there before, it hasn't been an issue. But when you look at just the state of the market and where we sit right now, this is where the $3.11 is really going to mean something more than it has in the past, because typically the previous view was that $3.50 was where people changed their patterns. So when you look at 356, 334, that's where you start to get where people are making that decision. And our argument is it's closer to $3.05, $3.15, just given the stress, the stress that people have had, where balance sheets are given some of the restrictions or problems during COVID. And again, these are going to be some of those pressure points that will be a headwind to some of that near-term gasoline demand. Now, we did get a small decline or normalization of weekly pricing. So gasoline came at $3.06. That's the one where we think it's going to stay here for a little bit longer. But where do we get in terms of a July 4th bump? And then when we look at diesel prices, you can see that there was still some of that steady move up. Just getting to $3.28.7. And that's where diesel remains elevated. But the question is now going to come down to, okay, well, before July 4th, there's typically a push to get gasoline to the market because people drive the most during that weekend. The holiday is a Sunday, so we have Monday off. So typically you pre-fill that. So if you think about what the timing looks like of trying to pre-fill, you're really going to do that. Start it this week, but then because you're pushing it up next week, and then the following week you're going to move it from point A from the rack to the pump. Make sure that it's there, and then you're going to have some of that slowdown on the week of July 4th, and then you get that acceleration back as you backfill what was pulled out. So you kind of preemptively move. So we're going to get a move up, move down, and then that move back up to some of that normalcy, which is what we're starting to expect. So some of this move could have just been some of that preemptive look. We need to rejuice the system. We have some of these shortfalls. We need to get product out there. So these are going to be things to watch on some of that noise going forward. Now, when we look at blending stocks, you can see that obviously we're off of 2020 levels, but we're still at seasonally adjusted all-time highs when you look at kind of where we sit versus that 2020 level. So we did get a nicer move down, and that's really just where things were with Pad 3. Some of those blending components did actually go into Europe with naphtha, but we'll talk about that in segment 3. Then when we turn to the last 15 years, you can see that we're following the trend. We had a spike above it last week, and now we're just following the trend line on that 15-year average. But again, we're still not back above that peak that we saw during the colonial outage. So here, when we take back some of that noise and look at just the last 5 years, taking out 2020, you can see that we're right back to where, just below that 2019 level. We were expecting to have this spike right into here, then a little bit of a drop, coming, obviously not, making a lower high, a higher low, but still within this comfort range. So now, instead of getting this push back up, and you can see the lumpiness that typically happens. And that's what I was talking about with July 4th push, July 4th drawdown, July 4th restock. And you got a little bit of a push. Now we'll get some of that drop down, and then we'll get some of that surge back up. And then we're going to go sideways for the most part, just given where those demand numbers are and where the market typically is sitting right now. Now on the propane side, we had a small build of a little over 1 million barrels. We're still about 9.8 million below the 5-year average. And as we've been saying, we're just tracking 17 and 18 here. So we've been tracking 17. That's the one that we think we're going to continue to track in general. And that's going to be, again, supportive of pricing. Pricing remains strong. And even though all of this is happening, the ARB is still open. We're still sending exports into the market. And we don't see that changing into Asia, though the naphtha backdrop is going to start to weigh on some of these exports, because naphtha, so now Asia's long naphtha, they don't want it. Europe is long naphtha. They took some of the last slug from the U.S., And we're going to start to see naphtha impacting some of the NGL market, which is going to be some headwinds for some of those flows. But just given, ethylene, ethane, there's going to be some stability in where those flows are going. But this is something that we're going to talk about next week, specifically when we go through the insights for clients as we start to look at where are some of these shifts going to happen and how is that going to impact pricing. So then when we look at where things shift, we're right back to where we were last summer for parks. There's really hasn't been too much change. Residential, when you look at just where we were at the beginning of the summer and where we are now, things have there's obviously a bit more activity as you look at retail and recreation. Things have normalized a bit, but they're not back above that 0%. You still have some of this depressed moves. Transit stations is picking back up. People are taking more mass transit. Still by no means where it was when you look at toll Easy Pass data versus other. You're not seeing a lot of that increase, but again, this is people starting to take transit a bit more, and we're seeing some of this peak in park activity. Now, when we look at Apple Mobility, things have essentially flatlined versus where they were. It's tough because this is going, we want to compare it based on where we were in June of last year. So here you can see where we were in June. Here we are now. We're pretty much right in line with the U.S. Outperforming a bit. But it's also going to come down to who owns an iPhone. iPhone is 20 to 30% of the market. It typically has a much higher cut in terms of just the wealthier side. So these are things to consider when you're looking at the Apple data. But then when we look at the previous Google data, we're starting to see some of those movements. It's just going to be a matter of how much and where some of those flows are. But when we look at Europe, the UK is outperforming, and really Germany and Italy are kind of right in line with where they were during that time period. Just given some of the restrictions that remain in terms of moving about within the country, that is where we think it's just going to be a bit more of a sideways move versus this acceleration to this to that high that we saw at the peak of July, where it's going to be a bit more muted to that sideways capacity. Now, vaccines continue to accelerate. We see China, Germany, Italy, France. All of those are really positive. Same with Brazil. South Korea is now woken up and is on that line. India starting to see some acceleration. Still, again, not where we'd like it to be, but getting much closer. They've had some great record months. And now the U.S. continues to slow down as people have either been vaccinated. Those that haven't been vaccinated don't really want a vaccine. So we're starting to see some of these friction points that are appearing within that underlying vaccination pace. But then when we look at the share of the populace, this is, again, we're starting to get close to that level. So the U.S., it's 45%, which is a little concerning when you think about some of that pace slowdown. So we really want to get to what has been deemed 60, 70, 80%. 70% is kind of that target number. And this is where that the pace is starting to slow down, just because you're getting that, well, do I need it? COVID is really slowing down. I'm not seeing it the same amount. And then as people, were already lazy, then they don't hear about COVID as much. It's not there as much. Then you'll start to see some of that pace drop off. So even though India's seen that acceleration, they're still only at 3.7% of their populace, which obviously India is a big country, so that isn't all that surprising. But the one thing that is good is that we're starting to see Italy and France start to break into that top of those tops, which is going to be a good thing for activity. Then when we look at Jet had a small draw of 370,000 barrels. It's still 3.7 million above the 5-year average, as we were talking about in the previous in segment 1. Here you can see, we were expecting a little bit of a kind of a sideways move. It wasn't really a drop or an increase. We were just expecting to go a bit sideways. Here instead, you got a nice little push. And this, again, coming to what is the expectations for 4th of July, some of this preloading, that's, so we get this push up. Now we're going to get a drop back down. But it's not like we're going to drop back to these lows. It's just going to come back to this, let's call it 1.3 million or so, just right back within the middle of that. And you're going to see some of those movements. And when you look at the previous years, you can see that there's typically this big spike. It's just a matter of timing of when that spike happens. So clearly it happened now. Then we'll start to see some of this pullback in general. And then when we look at just, departures, because there's TSA and then there's departures. So right now, airlines have decided that they would much rather stuff as many people onto a plane than add a new flight. And for those that have flown, everyone can attest to it's crowded. There's not as many flights available, and prices have gone up because, let's be fair, the airlines would rather make money right now and make up for the last 18 months than try to add back new flights. Now, they are bringing back some additional personnel in terms of some of the support capacity, but we're not really seeing new flights get added in terms of departures. So that's why when we look at departures, we want to look at where are things being driven. So have we gotten some increases? Yes, we have. We've gotten it in Europe. So Europe has seen some steady increases. The rest of the world has started to see some. But then when we look at Asia Pacific, we had that steady move down. We had a little bit of a decrease again. And then the US is flatlining right at these levels when we look at where things were in December of 2019. So we're right back to December of 2019 in terms of just activity, and it's just given comments where I think it was United that is cutting some of the July volume. We're starting to see some of these cuts in general that are just going to cap where some of this demand is, even though we've gotten we've had that steady increase in TSA. So globally, the passenger flight schedule for the 11 weeks ahead declined by around 1.5% since last week, the lowest level of cancellations in months. So we had a big increase in cancellations, and now the week on week is much less. But again, you're starting to see some of that friction in general. EMEA cut more than other regions, 4.8% lower than this time last week across the next 4 weeks, and then based on then when you look at Europe, departures in the Eurocontrol area increased by just under 9.3% week on week. Departures remain roughly half of 2019 levels. And then departures in China continued to decline as Guangzhou remained under restrictions in the Guangdong province. Again, these are things where China continues to weigh in terms of some of these movements, which is going to cap some of that activity in general. Now, when we look at TSA passengers, again, we're just following the trend back up to the which normally peaks on July 4th, and then you have some of this weird moves in terms of just activity. You saw it here on the average. You saw it here in 2020 where you have this big spike, then a big drop. And that's something that we think is going to happen again. And then as you go into this period, you typically kind of flatline. And as we've been saying, we were going to move along this level, still not at 2019 levels, and then flatline and go sideways in terms of just activity. And so far, that continues to be the case. Now, when we look at open table, again, it's going to be weekdays doing great, weekends, right around at that 15% below normal. Obviously, Sunday was a big day. We think it's going to be 5-10% better on weekends, 10 to 15% less on weekdays, and that's something that's going to continue, especially when you look at just where prices are and how it's becoming, or it has become, more expensive to eat out, which again is going to kind of weigh on where some of that activity is going to be. Now that we talked more about the U.S., we're going to turn around and talk about the global market and some of the things that we're seeing within that arena.